Hi, in this video I'm going to be covering the whole short situation around GameStop, the factors that helped cause this, the immediate consequences, the collateral events that are going on, and the potential long-term consequences of such a scenario. Short disclaimer, I'm not a financial professional or nor am I qualified to give any sort of financial advice. I'm just some random guy on the internet trying to analyze the current situation. So please do not take any of this as financial advice or any sort of professional advice. This is just a guy discussing and trying to analyze on the internet. So let's get right into it. One of the first things that one needs to understand is what is a long and a short position. A long position is nothing but the classic buy something, some quantity low and then sell it high. So you buy low and then sell it high. In a short situation, this is reversed. So one buys high and tries to sell low. So how does one buy something high? There's a little bit more going on there than that meets the eye. What one does in practicality is one borrows instead of buying. So let's say usually it's from a broker. A person borrows 10 units of some equity, let's say a stock in this case, from a broker for 10 monetary units. Then the person decides to sell it at this price. What the broker needs in the end is his 10 stocks back. So the person has sold these 10 units of stock in total for 10 monetary units, can be US dollars or euros, whatever. And what he aims to achieve is to buy them back at a later date or a later point in time, let's say at a lower price, let's say 5 units. So the price has been slashed into half. And then he then returns the 10 stocks back to the broker and keeps the difference, pockets the difference. So that's the idea behind it. Because of the whole borrowing that's involved, it gets more complicated than that because the broker needs some sort of security that the borrower can pay the stocks back. So usually, in current times, it's about 50%. So 50% is held as a caution deposit, in technical terms, margin. And if the position goes the other way, that is the price goes up, then as soon as the price leverage or the price difference hits the margin level, the broker liquidates the position and takes the margin from the borrower. So this is how it works. In depth into practicality, there are even more factors involved. Like if it's a stock, the borrower also has to pay part of the dividend if it's a dividend paying stock. And since the borrower is borrowing, one usually also calculates interest on the borrowed equity. So we're not going to go into all these details because we'll just stick to the bare minimum, what's required to analyze the situation around GameStop. So GameStop is what you would classify as a penny stock. In 2020, I think the lowest price it hit was around $2.80 something cents. I'm not entirely sure, but it's what you classify as a penny stock. What happened with GameStop was a lot of people in the professional side of the financial markets decided to bet against it, meaning they started to sell short. And the trouble here is, or the speciality about the situation is, many such firms were open about it. Now the reasons for being open about it, one particular popular firm tweeted that they are short GameStop, and they do their fundamental analysis. They some of them have these analyses as products that they offer to customers. So they pride themselves on their analysis, and they put these out as press releases in a way to showcase what they're capable of. So yeah, it's product advertisement, so to speak. Since the information was out in the open, it just happened to be that a Reddit forum, subreddit as it's called, wallstreetbets, started digging deep into this. A few users really dug into depths and figured out that more stocks were shorted than those existed. So at one point it was over 130% of GameStop that was being shorted. Now anyone who understands the financial background behind this would immediately realize that under a certain specific set of conditions, more specifically, if the stock price were to go up, there are a lot of people or a lot of position holders who are going to get into trouble, and because of the margin requirement with the broker, they will be forced to liquidate. And this situation is in trader jargon called as a short squeeze. What happens is, because of the whole margin call enforcement, many positions will have to get out, and this will keep driving the price up. Quite a few users by this point of time had figured out the situation and had positioned themselves for a potential short squeeze. And at some point of time, there was a certain element of resentment in play. So this is the resentment against the so-called hedge funds from the retail customer or the retail trader side. For 2008, for high frequency trading, which just makes the retail trader secondary in terms of profits and gains. So the notion that hedge funds have an edge compared to retail traders, and they had used this advantage to exploit retail traders, was growing, and specifically in this subreddit, wallstreetbets, people were really resenting this. And what they chose to do was take matters into their own hands and force the issue, force the short squeeze. So one thing turned to another, and a snowball effect happened, and people just started buying the stock into at the highest price. Until this point in time, it went up to $483 US dollars. That's phenomenal. $2 and something cents to 483. And the short squeeze did happen, and is still happening. And because of this, a couple of firms went into trouble. One had to be bailed out, namely hedge funds. And here I have to say that from the retail side, this was spotted, and the professional side missed this in this situation. But usually speaking, hedge funds are not dummies. Usually a well-managed hedge fund would not be wiped out by a single entity, but by a single let's say multiple sigma move in one particular equity. That's not how hedge funds are designed. What I see potentially going on here is an explosion of an umbrella fund category. So an umbrella fund is basically a fund of funds. Usually in the professional side, how big funds diversify is they invest into themed specific smaller funds. So some of these funds are short funds, and the requirements are have been getting more and more specific. So short small cap, short energy, short some sector, and so on and so forth. So there are very concentrated short funds that exist in this day and age, and any of these funds which have multiple percentages of their portfolio invested into something like GameStop would have faced the heat. And for a retail customer, this wouldn't make any sense. I mean, for me personally, it doesn't make any sense at all for a fund to be so concentrated. It's asking for trouble, because imagine if you hold a position of 5% in GameStop, you're let's say short position in GameStop, your upside is limited, how much ever it can go down to zero basically, and your downside is unlimited. And in this case, wallstreetbets has forced the issue to the point that the downside keeps going up. So if it goes beyond the entire margin level of the fund is done. So that's what's happening these days. That's what happened in the past days. So among the collateral effects, one of the other things that's going on is the offering of fractional shares. So this is something new that has come about in the recent years, and some brokerages are providing this. And this means even the small retail trader can enter the game. And what wallstreetbets also figured out is an understanding of options. Now, we're not going to go deep into, or not at all into the structuring of options. They are derivative instruments. What essentially wallstreetbets did is place enough call options at specific price points such that it forced the brokerages to go and buy more of this stock, thereby driving the price again higher and higher. Clever play. None of this is illegal. The only thing that is marginally that's on the border in terms of illegality or legality is banding up as a group to do this. But yeah, this is one of those strange things that's really really difficult to contain, because this is an inefficiency in the market, and someone would have eventually taken advantage of it. Usually it's one of the hedge funds, and it never even gets the kind of media rep that it's getting, this phenomenon. It's purely getting this effect because the person or the entity that benefited the most out of this is the retail trader, which is unprecedented. Good for them, but at the same time, I don't think any single entity is going to get into trouble for this, but there's going to be a lot of investigation. Now, apart from this, collateral events that have been going on that are fueling this, one of them is Elon Musk has been tweeting pro wallstreetbets. He's anti short sellers, and he has good reasons to do this, because GameStop just happened to be one of the most shorted stocks of 2020. In 2019, one of the most shorted stocks, if not the most shorted stock, was Tesla. So many people were betting against Elon, and he hated the situation, and he has his reasons, and he came out on top. And in 2020, when he sees something like this happening, he's pro, and every single tweet of his is influencing the market. So this is one another collateral event that's going on. Apart from this, one other thing that I picked up is because wallstreetbets being a subreddit and internet being involved, it was just inevitable that the crypto markets also get tagged along. So a lot of activity and volatility moving about in the crypto markets at the moment. And since again it's a subreddit and it's the internet, there are a lot of memes and humor floating around, and eventually and inevitably the Doge or the Doge meme has been popping up. And it was just a matter of time before Dogecoin, which, if you don't know, is a crypto asset that was born out of an internet meme. Yeah, that really happened. And people do make money out of this. So Dogecoin has been experiencing a blast in terms of its price. This has there are no financial analysis behind this. It's a I've been following some of the subreddits in this space. What's happening is people are utilizing the volatility in pure pump and dump fashion. Now, the term pump and dump is very specific, and this is the if you're not aware, this is the reason why crypto markets are not recommended for the normal person, because pump and dump is organized pushing of the price up and then organized selling at a certain price point to take the profits. Large groups, when they plan and execute this, are capable of influencing markets, and this is market manipulation. This is illegal in any other market space, which comes under the category of regulated markets. The stock market, it cannot be done, but in the crypto market, since it's a largely unregulated space, this still happens, and it just seems to have happened as a collateral event beside what's been happening with GME, Gamestop. So Doge has been experiencing this surge, and apart from this, Wall Street Bets also has this cheerleader board going on, which are, I think, a list of shorted stocks, and some of these stocks have also been experiencing bouts of surges. And this throws caution to the wind, because many people are losing their shirt over this, and something has to give, because we are used to the Hollywood archetype of the hero and the villain, but in reality everything's gray, meaning this is not a fault of the retail nor the professional side. We are facing issues here at a systemic level, and the solutions will also have to come at a systemic level. So one potential situation that could come about to play is regulation interfering into both sides, the retail and the professional side, because from the retail side, if a bunch of people can band up together and force this issue, this can be done anytime. Internet uncontrolled, because this price movement has nothing to do with the actual use case that GameStop is offering, isn't it? Again, on the other side, from the professional side, who decided that GameStop or any equity can be shorted beyond its maximum available number of stocks? In this case, more than 100%. So who decided that? How is this possible? So I think optimally regulation would enter into both fronts, and there are good chances that we will not be seeing such occurrences in the future anymore. That's one potential consequence of this. And at the same time, until firm changes like these happen, because of the trillions of dollars that have been injected into the system through the stimulus and the whole pandemic, because of which there's much less sports betting happening, because there are not many sport events happening. There could be also a scenario, which is very likely, that a lot of money enters from the retail side into equities, and this leads to injected volatility. This could lead to a short-term surge in the market, but whether this is a bubble that's about to pop, we don't know yet. But having said that, just the fact that this could be a bubble, just accepting the fact that this could be a bubble, is halfway a solution. So with this knowledge, one can protect oneself against such an event, or even profit from such an event. And how one does that is via hedging. So we've come a whole circle. Where we started is with hedge funds playing this little game, and to protect oneself, one needs to return to hedging. Full disclosure, I have a synthetic long position in GameStop and a long position in Doge. The position in GameStop came about completely exclusive and independent of the whole situation. Back when I made the position, I came in completely independent. The expansion of implied volatility is what drove me to make my decision, and then after understanding what was going on, I figured out the analysis that I'm just going through with you now. and with Doge, it's just been there. So with all this going on, the best we can do is try to analyze, understand what's going on, and best be prepared for all sorts of consequences that might come about in the future, because we can never predict. But from the fact that we cannot predict, we can be prepared for potential consequences of binary events either way. So I thank you for your attention this far. I thank you once again for your time, and I wish you a tremendous time ahead.